Good afternoon, folks. Hope you're all well. My name is Mahmood. I'm an accountant and educator by profession. I've been running my own businesses for about 26 years now. I've worked in that business space, both in terms of national, international, not-for-profit, private, for quite a number of years. I know you probably look at me thinking you're too young to have that level of experience, but take my word for it, it's happening. Now, today when I was thinking about a topic to cover, as part of our sort of weekly sort of sharing information about all those topics that are interesting in the business space of accounting, business, tax, and all the rest of it, I wanted to take a closer look in terms of the topic of costs. Not just a question of describing what the costs are, but actually some good, valuable takeaways about understanding your business cost and structure, not only understanding the risk that goes behind it, but in terms of how we can use that powerfully to manage our business accordingly. If you're just coming up on to listen to the broadcast, you've got nothing to do on a Saturday afternoon, you can do a lot worse than actually diving in here, having a listen to the conversation we're going to have. If you've got any thoughts to share, if you're coming on the replay, do the old hashtag replay. I see a couple of my friends and colleagues have joined me, people that I know, so I'm just going to give them a short wave and hello. I should say hello to my good friend and business partner on the Business Growth Club, broadcast on a Tuesday. Joe, hope you're well, Joe, and hope you're actually doing some relaxing for a change. Joe works very hard, as most business owners do, so hopefully you've got your fluffy slippers on and you're listening intently, and I'm no doubt you've got some good things to share with us. Jez, good afternoon to you. Liked your post earlier on today, hope things are well, and I hope you're liking the new layout in terms of the website address and the presentation there. So let's see what Joe's going to say here. Yeah. So Joe's a prolific writer and presenter of all good things, creative and entrepreneurial and all the rest of it. So I'm sure we're going to have some feedback from her as the show goes on and tips. So what I'm going to do, I'm going to try something new and innovative today in terms of, for me, it's not just a question of sharing content and saying, oh, here's the theory, here's what we do. It's really got to be applicable to your business. So whether you are a private business, an SME, a solopreneur, if you work in the arts, social enterprises here, this is something that's a real good takeaway and transferability for your business. I've been fortunate enough in my career to work internationally. I've worked with multinational companies as well. I've worked at senior director level, advising and supporting. I've worked for very humble solopreneurs. And all the businesses that I meet, have worked in, have had the delight to be connected to. One thing they all share in common is that financial issues, understanding and awareness are a really great tool. There's a commonality here that needs to be picked up to actually help in those businesses itself. So if I'm glad you actually got your slippers on. I'm not sure if you can actually exhibit them on the screen as such, but as long as you're comfortable listening in, that's all we can say. Now, what we're going to do over the next half an hour or so, I'm going to share some thoughts. I'm going to show you some examples. Obviously, if you've got any comments to make or questions to ask, please fire away, chuck them into the comments box. I always answer all the questions and comments that get fed in here. If you're coming up on the replay, as I've said, put the hashtag replay in there and I'll pick them up accordingly. Now, what we're going to do, we're going to have a look at some slides. This is not going to be death by PowerPoint, but they're good visuals that you can come back to, watch and listen. I'm also going to demonstrate some numbers for you. I think the theory is nothing unless you actually illustrate what's going on. So I'm going to try this online with a bit of a sort of online tool that I've got. There are some future resources coming out unpublished, which I'll flag up at the end of the broadcast. And if you're interested in diving deeper, getting behind some of the concepts that I'm going to be talking about today, these practical giveaways, by all means, check out the website, check out the resources page. I do a weekly podcast called I Hate Numbers. I shall point out that I don't actually hate numbers. I think they're a great way, a great insight, the numbers to your business story here, and that really gives life to what's going on here. All of us are capable, by the way, all of us have that capability of getting closer to our numbers. And if you're in business, it's an absolutely no-brainer for me that you've got to get connected to your numbers. So that's enough from me. As I said, this is a no-nonsense, BS-free discussion, conversation. I try to do that on all my content there as well. So what you're probably sitting there at home thinking, great, Mahmood, we're comfortable, we've got our fluffy slippers on, we're sitting back, we're listening, watching intently, but what are you actually going to cover as far as today is concerned? So by the power of technology, I'm going to be looking at effectively 3 key areas over this duration of this live broadcast. I'm going to look at your business costs. Now, obviously, I'm not talking about just itemizing them, but actually we're going to take a more powerful way to actually have a look under the bonnet of your business in terms of your business costs. We're going to talk about the risk. What's the risk of the cost that you actually have? I'm going to try and keep this minimal in terms of jargon free. I will throw in a couple of terms that you may have come across already there. And more critically, once we understand the costs, the types of costs that you're likely to encounter in your business, we're going to be talking about making decisions with that information. So more importantly is how you measure those things and how you manage what's going on here to make those really sort of good decisions going forward. So that's the 3 key areas that we're going to be covering. Again, as we go through, if there are any questions, there's no such thing in my opinion as a silly question. All questions are equally valid. Throw them into the chat box, the comments box, and I will answer as we go through. So you're probably sitting at home now, excited with your mug of cocoa or your gin and tonic if it's early in the day. So let's crack on with what we're doing. Now let's have a look at the business costs, first of all. Now for me, most business owners will get to grips with their numbers, their costs, typically when that annual exercise is carried out, that once a year exercise where we complete accounts for the tax authorities, we produce the numbers, or your advisors will produce those numbers and present them. Now that's fantastic, that's great for compliance, but for running your business, it's a complete waste of time. What we've got to do here is to look at the information that's generated from your daily transactions, your regular transactions, what you're spending, where the money's coming from, and we're going to use the framework of dividing those costs up into what I call how they behave, how they react. Now, the costs in the main that you'll typically find in any business that you are involved in will be those costs that are fixed and those costs that are variable. I'll introduce some alternative terminology for you, but let's think, what do we mean by fixed? Now, for me, when you talk about fixed costs, those are costs that stay the same, they do not change, but it's about what they're connected to. So typically, I would link and tie those costs up to your business activity, and that activity can be internal, and that activity can be external. Let me build on that a little bit more. So let's say, for example, we have a company that makes things. So it doesn't matter what it makes phones, it makes tables, it makes chairs. It's a manufacturer. Now, there are 2 main activities. There's the internal, i.e. there's the production line, there's the company actually making those items, and that activity is actually the production activity itself. Now, within that, there are certain costs involved in that manufacturing process that will remain the same, irrespective of whether we make 0 units or whether we make, say, a couple of thousand units. Now, those costs, for example, would be things like the rent on the factory. There would be typically things like the salaries of the supervisory team. There would be things like depreciation. There would be things like the rates on the property. And those costs will largely remain static and unaltered by any production activity. Now, if we translate that, we go to a different sector, like the hospitality sector. Now, I know the hospitality sector is quite affected, but let's assume a situation. We've got a restaurant, we've got a cafe, we've got customers waiting to be served. We've got the internal activity of the people involved in actually making the food, making the meals ready to be served or delivered. Now, again, within that environment, as we're producing meals, if we have a quiet moment, the costs of the salaries of our chefs, will remain static, will not alter. Whether we make 0 meals or 100 meals, that salary cost will remain the same. The rent that we might pay on the restaurant unit, again, will be static, will not change. Now, if you're a service business, you've got no products that you're actually making, effectively, it's the same idea. So you're at home, maybe home working, you've got an office space, and you're working on a client's work portfolio. Well, some of your costs, like the cost of running your office, the cost of your website, the cost of any, professional fees that you might be paying that are there for compliance activities, will remain the same whether you do 0 work or whether you actually do a lot of work. So that's the idea of fixed. Now, the other external variable you've got to think about is, which we'll expand on in the next slide, is when you're selling things to people. Again, whether you make 0 sales or you make lots of sales, some of your costs will remain static. So I think as a takeaway, what you need to do is have a look at the costs in your business and identify what they are. Later on in the broadcast, I'll give you some insight to how you can get the tools to actually capture that. But what you want to be thinking about is, if I did no work for the next couple of weeks, if I had no customers, if I had a 0 activity, maybe I'm on holiday or there's no work coming in, what cost would I have at the moment that would remain largely unaltered? Now, across that, into the next box, is the costs that are variable. Now, the idea about variability is it varies according to something. Now, I like to think of variable costs as what I call fluctuating costs. So if I do something, those costs will change. If I do nothing, again, those costs will change. Now, we can relate that perhaps to the cost of running a car. So if I've got a vehicle, if I drive it 0 miles, so it stays on the drive or outside on the streets, then certain costs will remain the same, don't alter, like the insurance, the car tax. But once I start to drive that car, once the activity of the vehicle increases, i.e. the miles that it travels, then the fuel costs in that vehicle will fluctuate accordingly. Now, if we transfer that to your business, typically, if you're making things, well, the more you make is the material costs that go into there that will also change as well. If you're a restaurateur, it's the food costs that will fluctuate according to how many meals that you make. If you make 0 meals, then there is no material costs, there's no food costs. Trust the accountants to call it material as opposed to food. If you sell lots more meals, then that actually goes up accordingly. Now, if you are a service-based business, it may be that some of your staffing resources comes from freelancers. So if you've got a lot of project activity going on, you've got lots of work to deliver, then the cost of your freelancing costs, your subcontractors as such, will also fluctuate according to how much work you've got. So I think the first takeaway is look at your costs broadly between those 2 buckets. What are those costs that are fluctuating and will alter according to how much work you're doing, how much internal activity? What are those costs that remain constant? Sometimes we call those committed costs that will not fluctuate irrespective of whatever business activity level is. Now, there are always a hybrid, some bits are in the middle. So, for example, things like telephony costs. Again, there's a standing charge and amount you pay for the consumption. Largely, though, in terms of just getting a handle on this, I would probably use those 2 buckets there as well. If the monies are involved and quite significant, it's worthwhile split them out, but crudely have those 2 buckets. Now, as we move on, let's expand that a little bit further. Now we'll look at the risk. Now, the risk to having a cost structure, and I will emphasize at this point, by the way, that I have come across some wisdom that says you mustn't have fixed costs. You've got to keep your costs down to a bare minimum. Well, against that, I would probably say that's not necessarily good advice. Sometimes it's good to commit to a level of fixed costs. Sometimes it's good not to commit to a level of fixed costs. So one great example that all business owners have that question in their mind is, should I employ staff, put them on my payroll, or should I outsource them and bring them in as and when required? Typically, there are 2 or 3 things that we need to take into account. So if I've got a resource need, so I can't carry out all that work myself, and I actually want to increase my ability, increase my capacity, free up some time, I might make a decision to employ somebody and put them on the payroll. Now, the upside is I've got that internal commitment. I've got that ability to call on that individual. That individual is more likely to be focused on what I want them to do. The downside from a costing point of view might be, well, actually, that's added to the payroll. That becomes a fixed cost and all those obligations that come with that. If I haven't got any work for that individual, then I've still got to find the money to actually pay that wage bill. And that's an understandable trade-off. So for that, when somebody's on your payroll, they become a fixed cost. And that means that you're committed to making sure that you pay that wage, you service that holiday pay and all the obligations that go with that. If they're outsourced, they're a freelancer or a subcontractor, largely you could see that as a variable type activity, a variable type cost. If you have no work, very simplistically, there's no commitment to use that resource. If you have got work, then you have that. Now, I'm going to be talking about outsourcing and that thing in future podcasts and future broadcasts. But if we look at that distinction between that idea, we'll see as the numbers become more alive about why actually sometimes it's good to have that resource as a fixed commitment and sometimes where it's not. So the risk comes is if when the activities change. So if the level of work that you've got internally, so you're producing ready to sell, you're preparing things ready to sell onto your customer, the internal dynamics of your company, it's the activity levels which determine the level of risk that you'll be exposed to with your cost structure. Also, when it comes to the most difficult number to ever predict for any business, i.e. what are you going to sell to a customer, that volatility in your sales is also another determinant behind the level of business risk that you have. Just to share with you, by the way, just in terms of technical terminology, if you ever get involved in a conversation with an accountant, which is probably not something you might necessarily desire, the official terminology in the world of investing, in the world of management, is what they call operational gearing. That's a very technical term there as well, but it really says it's the risk that a business faces to the cost structure it has in its own business. So let's move on. So we talked about the business costs, we've talked about the risks, we've talked about the measuring and managing. Let's move on. My slides are getting a bit wonky. That's repeating itself. There we go. Now, what I'm going to do here is to illustrate in a moment 2 businesses that have got completely different cost structures. So I've very originally called them Business A, and I've called the second one Business B. Now let's have a look at those 2 businesses as they stand. You've got a similar and the same sales line for both businesses. They both have got sales lines at £200,000. Anyone who's listening from overseas in the US or otherwise, obviously substitute pound notes for dollars. So really, it's the same application irrespective of where you are. Now, what we have here is Business A has got variable costs, so things like materials, commissions being paid to sales staff, subcontract staff, etc., of 120,000. Business B has got variable costs of 30. If we look at the other type of cost there, fixed here, we've got Business A that's got a lower cost commitment in terms of £30,000, and Business B is carries a heavier burden of fixed costs. Maybe some of its staffing is employed. Maybe it effectively has more of a higher burden there, and that's 120,000. Now, on paper, they're both making the same level of profits, and they've both got the same cost burden. If we look at the bottom, though, in proportionate terms, Business A has got a lower proportion of fixed costs, and Business B has got a higher proportion of fixed costs. In the world of official language, what you probably say is that Business B has a greater level of operating risk into its cost structure. So it's gearing. The Americans will call it leverage. If you're listening from the States, congratulations, well done. Thank you very much for listening to the show. So Americans will call it operating leverage. We in the UK call it operating gearing. So Business B is said to be more risky in terms of cost structure because it carries a heavier burden of fixed costs. Now, for me, it's a question what goes on next that determines where the greater level of risk actually will be felt. So now this is where it's either going to go disastrously wrong or disastrously right. We're going to demonstrate the impact on this itself. So let's have a look. Now, what I've mocked up, now remember from before, we're going to look at two scenarios here. Scenario one is where the business anticipates or experiences an uplift in its sales line. Now, what we're going to have a look at in a moment is when we see that sales line change for the positive, what the impact is in terms of overall profitability of the business itself. Now, let's see if this works. Let's make it a little bit bigger so it's a bit more visible. Now, I don't know what your own thoughts are. So what I'm going to do here, and if this works, is just factor in something nice and straightforward, like a 10% hike on the sales line. Now, if we look at a 10% hike on the sales line for business A, what we'll see, there's an £8,000 change in profit, and that's a 16% improvement of what happened before. And let's see what happens when we do the same situation for business B. If you remember, business B carried a heavier burden of fixed costs. Now, what we'll see there is the profit change is more dramatic for the positive in business B, a £17,000 uplift, and in proportionate terms, that's 34%. Business A still experiences a profit uplift, which is good, but the magnitude of the increase is not as great. It's £8,000, and that's a 16% business hike. Now, the question is why? Well, the answer can be really seen in twofold. Number one, because of the heavier cost burden, the fixed costs, the theory behind that is if you increase the level of activity within a certain degree of margin, the fixed costs remain unaltered. If you imagine your own businesses, whether you're working within them, if you pay yourself a salary, or if you work for other people, if your business does better, you don't necessarily reward your staff with higher salary costs, so their costs remain the same. More rent doesn't get paid to the landlord if your business does better prosperity. So therefore, those costs that you have do not alter. They're spread across a wider base of sales, and therefore you will enjoy a greater level of profitability. So, conclusion, if your business carries a high level of costs and you're anticipating strong sales lines and a growth upwards, then it makes a lot of sense, you'll make more money. When you make that decision, should I take on a member of staff and employ them, you've really got to look in terms of the level of work you anticipate, how much business you expect to generate, and therefore it makes sense in that respect to actually have staff employed as opposed to freelancing. Obviously, if things are a bit more volatile, you're not quite sure, then there's an argument perhaps for keeping somebody on a freelance, a subcontract basis. But again, that argument is very simplistic, but again, notes those factors we consider. Now, what I'm going to do now is to see what happens if it goes the other way. So this is now where we might experience volatility the other way, where we get a sales decline. Now, I don't know what your expectations are, thoughts are. If we go down that route, let's have a look at what's going to go on. So if I bring up now a different scenario, and this is where we're going to experience a negative change, i.e. we have a sales decline, and what we're going to see what happens there. So what I'm going to do, ladies and gentlemen, I'm just going to make the screen slightly larger. It's going to hide the comments temporarily, but I'll come back to that in a moment. If I can do this correctly, that's a 10% drop. Business A, what we can see there's an £8,000 profit change, and that's the 16% going the other way round. If we reflect that also for business B, we'll see the profit decline is far more than it is in business A. We're now experiencing a 34% decline in profitability. profit decline is £17,000 from where we were before. And if we look at the proportion of fixed to variable costs, you can see it shot up much more dramatically. Now I'm just going to leave that on the screen for a second or two, let that conclusion settle in before we think, what do we do next once we're armed with that level of information? Okay, so let's come out of there, bang. So what we'll see then, as probably not a surprise, is the logic being that if you're carrying a heavier burden of fixed costs and sales line are declining, or the activity of manufacturing declines as well, you've still got to carry that cost burden. Those variable costs will decline in line with that decline of activity, but your fixed overheads, your costs, will remain static, and therefore one doesn't see a dramatic reduction in overall costs, and therefore profit takes a bigger hammering. So therefore, for me, what's the conclusion going forward before we go to the next slide? Obviously, know what your costs are. And in terms of, if your traditional way of looking at costs is by functionality, or spending money on salaries, spending money on rent and rates, but you don't have that next addition to describe them by what they are, fixed or variable, you're missing a trick. Your current systems, your accounting systems, can be configured to deal with that. And certainly for managing your business, relying on financial documents and statements, for me, is actually you're missing out a great deal, and actually you're missing out the ability to understand what's going on and take your business forward in bigger leaps. Let's go back to the slides now and just explore the last couple of things. Oh, in fact, let's go back here. Right, so I'm going to go back to stop sharing in a moment. I'm just going to share some thoughts about here, what we need to do. Now, we talk about measuring, by the way. So definitely the one thing I've shown you, that looking at the proportion of variable and fixed costs, is one way to understand that. There are other measures as well. So things like break even, at that point where you cover all your costs, you don't make money but you don't lose it, is one other metric to adopt. You can look at effectively what they call the level of profitability that you're making in gross terms. Now, as a helpful tool and a hint, I'll drop a link at the end. We've got, I'll just finish it off yesterday. It's gone live. It's a break-even calculator. So whereby you can type in online, get the results straight away, what's going on in your business in terms of what your fixed costs are, what your variable costs are, and it will tell you things like what your break-even point is. Now, there is something in there also called what's called a margin of safety. So in other words, you type in information, you say what you're normally expected to do. A margin of safety is another metric which gives you a cushion, an idea about how much your sales can decline before you start getting squeaky bum time. So I'll drop the link in at the end. It's a free online tool to assessing where you are in terms of break even, making those decisions about what you need to sell, how much you need to sell to make profit or to stand still. If you're interested, again, check out the website. There's lots of free resources there looking at costs, fixed and variable, giving you a bit more insight to what's going on. Tomorrow's podcast that's coming out on a Sunday morning is about ways of diagnosing failure. There is a linkage between all these things and risks. So hopefully you got something useful out of this show today, everyone. Now I'm going to be back on a regular basis, obviously weekly, talk about anything that's business tax related. Next week's topic that I'm looking to do, there's been a new change that's been kicked in the grass from October 19, it's coming back, being introduced from the 1st of March 2021. And it's about what they call domestic charge, reverse charge for VAT for those working in the construction industry. Now, I've been fortunate in my business career to work across social enterprise sector, private sector, multinational, international, and all the rest of it. So I'm going to bring my knowledge and understanding and qualifications to bear. In these broadcasts, I'll be talking about all things tax, business, numbers related. If there's a topic that you would like explored or get a bit more insight, then by all means, drop me a line, drop me a comment here. I'll have a look at that and maybe shove that into my content plan. But apart from that, everybody, I hope you've enjoyed the show. Thank you very much for your company today. Thank you very much for your feedback. Have a fantastic week ahead, and I look forward to seeing you guys very soon. And I think let's play out with our wonderful little song. Well, it's not a song, is it? It's a bit of a track. Let's go.